Today, we're going to talk about what Trump's tariffs really mean for your retirement. After helping hundreds of Canadians retire comfortably, we know that major political changes can directly impact your retirement plan. That's why we want to make sure you're informed and prepared. In this video, we'll break down exactly what these tariff changes are, how they could affect your retirement, and the strategies you can use to adjust and stay on track. Let's get right into it.
Yeah, John, this is a really uncertain time. Trump is threatening all of these tariffs, and a lot of people just aren't sure of what they mean and how much they're going to be. So let's just set the record straight. There are tariffs that are being threatened, and for the most part, they're going to be 25% on imports coming from Canada and Mexico. And there's going to be a significant additional tax on a wide range of goods entering the US from these neighboring countries. And one of the exports that Canada is well known for is energy. And so the US is implementing 10% on all energy imports from our country. Now, I think with the government knowing all of this, there was thoughts of retaliatory measures to be done by Canada. And both Canada and Mexico have signaled that they will be putting on counter tariffs on US goods, which obviously could escalate those trade tensions. Now, if you don't necessarily understand, tariffs are going to interrupt the supply chain. And that's particularly in the industries of automotive and the manufacturing sectors, which will increase to the production costs of these different industries. But up until this point, the financial markets, I don't know if you've noticed, but they have shown resilience. These concerns continue to persist, and they could have long-term economic impacts, and that could lead to recessions in Canada and Mexico. So knowing that all of this is happening, tariffs being implemented, retaliatory tariffs on US goods, why is that important for us to know, and what could that do?
So really the biggest impact that we're probably going to be seeing is we'll have some degree of economic slowdown. Usually when you're having this taxation, essentially that a tariff is on trade back and forth, it's either going to force companies to look to a different supplier, maybe that's away from the Canadian market or away from Mexican markets or vice versa. And this can cause a little bit of a slowdown on the production of goods or higher costs for the production of goods. And it's a good thing I brought up higher costs because that's going to lead to inflationary pressures. If a business or supplier is paying an extra 25% for the goods themselves that they're selling, usually that gets passed on to the consumer, and prices may not directly go up by 25%, but they'll probably go up in some capacity. That's going to lead to a lot of volatility right now. And with that, it could lead to volatility within the stock markets. Whenever there's trade uncertainties, impacting these major economies, it could have an impact on your retirement savings. And going back to it, sometimes when people have stocks, they also are going to have bonds. With the inflationary pressures, sometimes that leads to interest rate adjustments as well. I know in Canada, the trend has been downward for the interest rates because inflation had been downward. Now, granted, if inflation now starts to go up, we could start to see interest rates potentially go up as well. So there's a lot hanging on these decisions with the tariff conversation. And there's rightfully so that the Canadians are a little bit more nervous with the conversations that have been going on with our closest trade partner in the US.
Now, as you can see, there are a lot of rapid changes happening that could change the Canadian economy forever. So if you're concerned about how this affects your plan, click the first link in the description to watch a complimentary video we created. It breaks down the exact system we use to help clients create an adaptable plan for situations like this.
So, Carlo, knowing what we know about the current tariff situation now, what negative outcomes can surface for Canadian retirees?
Yeah, no, that's a great question and something that many people are concerned about. With the increase to expenses in these companies, it could have impact on those stock prices, and it could essentially lower retirement savings that retirees have and what they're expecting to be able to spend in retirement. As I said, the market volatility from the uncertainties can just drop the value of your portfolio at a very inopportune time. And if you have a heavily equity-weighted portfolio, it could suffer losses if there are impacts on Canadian and US companies. Also, you talked about it earlier. With inflation and rates changing, it could have an impact on the Canadian dollar. And if our Canadian dollar drops, it just means that your dollar doesn't go as far and can't pay for as much expenses. We also are a country that exports a lot of energy. And if those tariffs occur, energy prices could increase and disrupt those supply chains all across North America, and it could lead to higher utility bills. Again, just compounding the issues with, lower value of your portfolio, lesser Canadian dollar,
Yeah.
your money won't stretch as far. You may have to delay retirement. If your savings take a hit, you may need to work longer just to compensate for that shortfall. Also, if there is a recession or a slowed down economy, there could be job losses.
Yep.
And it might make it harder for workers to be able to save. They might have to retire earlier. Also, if you are expecting to earn a pension in retirement and it's not indexed to inflation, again, that source of income may not be able to pay as many expenses as you once thought, given the lower Canadian dollar. Lastly, our governments, in order to help our citizens, may have to introduce higher taxes on income, investments, or on consumption to offset economic losses from these tariffs.
As you can see, these tariffs can have a massive impact on your retirement. So to make sure you have everything you need to help adjust to these changes, we're going to give you an actionable strategies you can start using as soon as possible.
So it's not as though we're trying to scare Canadian retirees or Canadians preparing for retirement, but it is a reality.
Mm-hmm.
So if this does occur, what can Canadian retirees do to better prepare for this situation?
Yeah, it's a conversation we've been having with our clients forever. It's diversifying. This is a great example as to why we need to diversify. You're spreading your assets across various sectors, geographic regions. This reduces exposure to any single market's volatility. So you're not only investing in the US or Canada, you're all over the world. It's important to stay informed, monitor the economic indicators and trends that may impact our investment strategy. But again, when you diversify, there's a little bit less that you have to make any sort of necessary changes as long as you are invested all over the world. Potentially even adjusting your risk tolerance. Some people, especially in a good market, feel that they're a lot more willing to take on risk until things turn south. So this is a good opportunity for you to kind of do your own check and balance and realize, what is your risk tolerance? Things change in 10, 15 years. And if you're getting closer to retirement, you might feel a little bit more comfortable with a little bit more scaled back in terms of risk. There could be an opportunity as well for increasing savings rates. The potential lower returns, we say this often, kind of give an opportunity that you're able to buy into the same fund, whatever that may be, at a lower price. So saving actually in those times, you're essentially buying low. Could be a pretty good opportunity. One thing that people need to focus on as well is considering potential inflationary risks. And if with inflation potentially on the rise, the best way to keep up with inflation is investing in those companies that have rising costs and rising prices. Because if they're increasing their costs, they're making more money. If you're investing in them, you're keeping up with that rate of inflation. Where some people fall into issues or an area of concern is you start investing in GICs, start investing in things that are more guaranteed. And when this happens, essentially you're locking yourself to a 2, 3, 4% rate of return. Who knows where inflation is going to be? We saw in 2022, inflation went up to as high as 6%. If that does happen, you're essentially guaranteeing that you're not keeping up with the rate of inflation. So the best indexed or the best way to kind of index with inflation and keep up with it is invest in the companies in a diversified approach. So, Carla, we've been having meetings with our clients about this, and obviously it's been a number one topic of discussion for Canadians for well over a month. What is some of the advice that you've been providing, and where do you kind of think things are standing right now with the tariff conversation?
Yeah, no, every single meeting I have, it's guaranteed that the question will come up. Yeah. What do we think about Trump and how the tariffs are going to impact their retirement plan? And I have to take a step back because I have to be sensitive to the fears that these people are having. And, even for myself, it's a little bit scary being with the uncertainty of what tariffs could do and what Trump could do in his presidency. But again, taking a step back and understanding what we're doing when we are investing our money. Mm-hmm. We are becoming shareholders in many different companies. And as we know, companies are in the business of making money for their shareholders. So we know that at any given time, the stock market can drop. And whether it's attributed to a war, interest rates rising, tariffs, economic changes, they can all attribute to a drop in the market. But companies see that happening and have to adjust how they're operating in order to remain profitable. So either have to increase top line revenue to offset these tariffs that are occurring, or they have to find ways on the other side of the financial statement to reduce expenses to accommodate these tariffs. But again, companies will adapt. Mm-hmm. Some may take longer than others. Some may not be able to, and unfortunately go insolvent or bankrupt. And that's one of the benefits of being so well diversified is any one company that goes insolvent, we're not necessarily going to get hurt by. So I think that's what, in my meetings, I'm just reiterating the fact of what we're doing when we're investing. We're not speculating on specific countries. We're not speculating on specific industries. We know money goes up in the stock market, but there are temporary declines. As long as you're staying invested, you're going to participate in the inevitable recovery.
Yeah. Yeah. My favorite line in this is, "This too shall pass."
Yeah.
There is always going to be a new reason why the stock markets are going to take a tumble. Obviously, we've been through COVID. We've been through the 2008 financial crisis. There was a stock bubble in 2001. There's always going to be a new reason why stock markets do turn south. And essentially, even with Trump and the tariff conversation, we've had that as well already back in 2018. He had negotiated the North American Free Trade Agreement with Canada and Mexico. Stock markets were still fine after that point. There was tariffs that were put on Chinese products back in 2018. Stock markets were still fine after that point. It does come with its own temporary drops, like you did mention. Markets are going to react based on emotion. It's just a billion different people's emotions is what moves the stock markets. But at the end of the day, we get through it. Just like you mentioned, the perseverance and the power of businesses and the perseverance and the power of people. As long as we still have to put clothes on our back and put food in our fridges, the markets will still continue to move forward. So this is one of those things. We take it with a grain of salt. There's going to be another issue or another reason why the stock markets will fall 5, 10, 15 years from now. It just continues to happen. But all we have to do is continue to focus on our goals and make sure that we're, setting our clients up and our viewers up for the most financial success in the long run.
Now you know how these tariffs impact your retirement and the steps you can take to navigate these changes. But we understand that adjusting your retirement plan can feel overwhelming. If you're unsure about how to better secure your financial future, click the first link in the description to watch a complimentary video we created for you. It breaks down the exact system we use to build flexible retirement plans for situations like this. We'll see you in the next one.